Well, I think if the past year or even couple of years have told us anything, it's that captives are getting more popular than ever. We have been hearing reports, and everyone in the captive industry, I'm assuming too, of how popular captives have been, how many inquiries service providers are getting. But stats from the regulators show that some have registered more captives in the first quarter this year than they did in all of 2020, which is fantastic news for the captive industry. In that note, this is the third part in our series on the journey to forming a successful captive. Parts 1 and 2 are available online, so if you've missed those, please you can go back and look at those, and we have some wonderful panelists. Today we're going to be talking about captive implementation. Before we start, I'll just remind you that you can ask questions. All you need to do is go to slido.com. It'll ask you for a hashtag. You can just put that in and ask your questions. You can also see what other questions people have submitted and vote for those as well. We'll be asking our panelists questions throughout the webinar, and also we have a dedicated session at the end too. So just make sure you get that ready, and if you think of a question, we can make sure it's answered. So on that note, for those of you who don't know, my name is Lauren Ingram. I am the editor at Captive Review, and I am very lucky to be hosting and moderating this panel today. Our other guests that we have are Chaz Lavelle from Dentons, we have Chris Dalziel from London and Capital, and we have Ollie Schofield from RISCS. And I'm very excited to welcome them all here today. I think we're just waiting on Ollie. But yeah, Chaz and Chris, thanks so much for being here today. And Ollie, now that he's here.
Well, thanks for inviting us, Lauren.
So obviously all of you have slightly different focus in the captive industry, but you're all working closely with captives. And one of the first things I thought we could talk about today is that when people are considering a captive program, obviously they do an initial feasibility study. And we've spoken about that in some of our previous webinars. But once you have that, how does a risk manager determine risk appetite and retention levels? And what are those first steps to work out exactly what that should be? Ollie, what are your thoughts?
So clearly the risk appetite and the risk retention analysis is a fundamental part in the process of determining whether or not a captive is going to be the right solution for any given organization. And I think as a starting point, we should always keep in mind the difference between what is the calculated optimum risk retention level and the actual risk appetite of the business, because the two can be very, very different and can be poles apart if you only rely on the financial metrics of an organization. So as part of the overall analysis of determining what is the right level of risk retention and how that fits in with the overall risk appetite of the organization, we would always advocate having not just the risk team, but very much the finance and the treasury team involved in that determination. And really there are 4 steps that need to be undertaken in that process. The first one is to carry out a historical claims performance review for the lines of business that are being considered for the captive vehicle. And that would include a review not only of the historic claims frequency and severity, and then some form of Monte Carlo simulation to determine and consider what the future situation could be, but also to consider what that might be under various different scenarios. So typically, I would expect to see a best case scenario, an expected case, and a worst case scenario. Now that's not only critically important for the risk and the finance teams of the captive owner, but it's also very important for the regulator. And I know we'll talk a little bit later on about regulators, because obviously they want to understand that the captive owner is going into this with their eyes wide open as to what the absolute worst case downturn situation could be. So that's the first part, the review of the historical claims performance. I think secondly, we would always advocate that organizations think about how they go about identifying risk, assessing that risk, and then evaluating what that risk might actually look like. in any particular scenario. So for that, we would consider the financial exposures that would come to the organization from any increased retention, so that we can understand all of the possibility volatilities that might be associated with these various aspects and the impact that that might have on the increased retention. And I think this is particularly important when we're looking at harder to insure lines of cover rather than just the pure traditional insurable risk exposures. Then I think the third part is to undertake a financial review, and that's looking at some of the captive owner's main financial indicators. So that could be how turnover has changed over the years, how their financing arrangements have changed over the years, what their expected financial requirements are in the coming few years, what the volatility is to their balance sheet from, for example, changing commodity pricing or stock pricing, and understand again how any potential losses that might go into the increased retention could impact on any one of the key financial indicators for that organization. So a very thorough financial review. And I think then the fourth part is looking at an overall funding review. So it's all very well that the conclusion of the first three parts might say you should take a retention of 5 billion aggregate. Okay, in the event that there were to be losses that exhausted that 5 billion aggregate, where is that funding coming from? Because obviously you don't fully fund the captive day one. You will have a certain withheld amount, and whether that's in called share capital, subordinated loans, letters of credit, trust, etc. Where is that money actually going to come from? And how will moving that money or earmarking that money impact the organization when it comes to available cash flow? So a lot of moving parts in there, but all very, very interlinked and all critically important. But I would reiterate that one of the most important discussions right at the get-go is to work out the difference, if any, between risk appetite and risk retention capability.
And just interestingly, because obviously you mentioned when you don't have a claims history, if you're trying to insure new risk, I know that a lot of businesses, not necessarily already in the captive space, have come out of the last year realizing they did not really have business interruption cover for when it was not caused by physical damage. What are some of the considerations when you've got something like that where you don't have a claims history?
So that's an incredibly important part of the discussion, because of course, whilst we can look at historic claims frequency, what if there isn't any historic data? First of all, what we'd look at is general industry trends. So in the event, I mean, you talked about the pandemic, we've had this event. What could the loss situation be for an organization? We have to have a certain amount of blue sky thinking and probabilistic analysis, because if you take the event sector, they know that their maximum liability, if the event was cancelled, is going to be X million pounds, dollars, whatever. And regardless of whether they have the cover, they know that that's their maximum exposure, because that's a financial exposure that they have already on their balance sheet, and they should have perhaps quantified as being a worst case business scenario. So that certainly helps. Other areas, if you're looking at completely uninsurable or non-traditional insurable risk exposures, as we identify what those risks might be to the organization, and we determine from an assessment point of view what sort of limit might be appropriate, we can then also look back and say, well, if these are the triggers for that particular policy, what would have happened if that type of policy had been in existence for the previous 5 years based on the financial performance of the organization?
It's just very interesting, I think, especially with these risks that are coming up that are essentially new, especially when you're looking at technological advancements. There's a lot of considerations, obviously. But obviously,
Lauren?
Sorry, yeah, continue.
Yeah, I wanted to echo something that Ollie said about volatility. There's also a psychological component here. The organization may be able to absorb a £5 million loss, but that might occur the very next day after the policy goes into inception. And the question is, when it stops being abstract and starts being real, will the organization psychologically absorb that and just move on?
Yeah, and that's always such a big question mark, isn't it? With all of these things, you set up a new insurance policy within your captive, and the first day you have the worst possible loss, the 1 in 100 year scenario, and as part of the risk retention analysis, I think it is important that companies get their head around the fact that this could indeed happen. And what does that then mean for the rest of the policy year? What sort of reinstatements or stop loss policies or drop down policies might be in place from the point of view of the protection of the captive? But always plan that, or always believe that this worst case scenario could well happen day one. I mean, that's one of the discussions that often people will have with underwriters. You know, the reason I'm buying this policy is because I think there might be losses. I just have no idea when they're going to happen, which is why I'm buying this policy. And it's very much the same approach. This could happen, and I need to be psychologically and financially ready for this.
Nobody buys insurance hoping it will pay off.
Yes, I'd rather buy insurance and never have a claim.
Yeah. So I think as well, one of the other main questions a lot of people have, and sometimes what slightly drives people to initially look at captives is things like tax. And I think any captive expert I speak to, they always say, look, if your main thought when going to captive is just for tax benefits, then it's not the right fit for you, because obviously it's a very long-term strategy. But there are a lot of questions around compliance and tax, not just from the start, but then the continuing requirements that you have for reporting and things like that. What are the important milestones during the formation process, Chaz?
Yeah, and I think of this from the perspective of a business person who's thinking about setting up a captive. To me, there are 5 different parallel paths they have to encounter. One is the corporate. How's it going to be structured? Secondly, the insurance regulatory piece. Thirdly, contracts. Fourthly, tax. And fifth, securities. So from a corporate standpoint, and again, all the jurisdictions and domiciles may be different, but just in general terms, traditionally captives had been corporations. But more recently, depending on your domicile, they might be a regular corporation, they might be a not-for-profit corporation, they might be an LLC, they might be a cell captive or segregated account company, they might be a series LLC. Regardless, there will be some, in terms of compliance, some mechanism to authorize people to act on behalf of the company. Articles of organization, articles of incorporation, bylaws, and there'll be obligations to have meetings, etc. But there may be specific obligations as a result of being an insurance company. So you may need to have a resident director. You may need to have a meeting in the domicile at least once a year. And if you've got a cell company, the individual division, that is the individual cell or segregated account, in theory, the creditors of cell A cannot go after the assets of cell B, and the same with a series LLC. So that's the corporate piece of compliance. Secondly, insurance regulatory. I mean, we're in this solely and exclusively to have an insurance company. So you have to apply for a certificate of authority. Some people call it a license. It's technically a certificate of authority. And there'll be various things in there. There'll be a business plan. There's probably actuarial. What happens, as Ali said, if you have expected case or worst case, what's the funding going to look like? Biographical information. Insurance is highly regulated. And then once you get your certificate of authority, there's the initial capitalization. Sometimes that can be in cash or letter of credit or surplus note. That is a note that is subordinated to the payment of claims first. There are subsequent filings, an annual statement, audited financials, a statement of actuarial opinion. There are exams I think Ollie's going to talk about later. And as you go along, to the extent that you change what you're doing, you have to change your business plan. Even though it is in the future, it is good to think about in advance at the organization stage, how do I get my money out? And you will generally have to get permission from the regulator to make a distribution and sometimes to make a related party loan. And you'll have to adopt an investment plan. And I think Chris is going to talk about that in a little bit. And then contracts. What's an insurance company do? It enters into insurance policies, reinsurance agreements. If you're in a pool or a group, you'll have additional documents. All of those are contracts. And so from the get-go, you have to consider, what do these contracts obligate me to? And when it comes to the insurance risk, as Ollie said, trying to determine what it is that is being covered, there has to be a full briefing and understanding by the officers or the principals or the advisors. And a best practices course is to get the commercial broker involved to make sure there are no gaps and no overlap of coverage. And there are a series of service provider contracts that have to be entered into at the beginning, you know, with the actuaries, the financial auditors, the captive managers, the lawyers, the claims management, investment advice, et cetera, tax return preparation. Then there's tax. We're not supposed to talk about tax, but, you know, in the US, it's fairly elaborate rules, non-tax business purpose, and that thing, that insurance risk has to be an insurance risk, shifted and distributed, and you have to have common notions of insurance. Looks and feels and smells like insurance. It is organized, regulated, operated like an insurance company. It is capitalized properly. It has proper premium pricing, valid policies, and claims paid. In the US, you're going to be subject to US tax. If you're not US, you can elect to be subject to US tax. If you are not US, but you're insuring US risk, there's an excise tax. And even if you're not a US company and you got US shareholders, sometimes they have to pay a tax. To summarize the tax piece kind of financially, in order to get money out of the company, ultimately, you're going to have to pay two taxes, either two income taxes or an income tax plus an excise tax. And then finally, securities, if you're in some kinds of groups or sometimes series LLCs or cell companies, there may be disclosures and you may have to sign those. So those are it's a myriad of compliance obligations, both from a tax and regulatory standpoint.
And so really interestingly, because I know you mentioned quite a lot of things, but in terms of considerations, I know there are a lot of requirements that prior to the last year required presence in the domicile, especially in the US and a lot of places. But a lot of regulators have said, you know, for now you can do it virtually, you know, we're in a situation. I'm just curious about your view about, will that be a permanent change? Or do you think regulators will go back to getting people to be present in the domicile for these meetings?
Well, I think we will go back to the 2019 rules. There were even in 2019, depending on the domicile, there were not everybody had to be present in the domicile. That is, as long as some of the people were in the domicile and everybody else was otherwise on the phone. Now, what we may see in 2021 is more Zoom. Everybody's on the Zoom as opposed to everybody's on the phone.
Mm-hmm. And I mean, obviously, as well, Chaz, you mentioned investments, and we have Chris here who knows all about that. It's a really important part of the captive formation process. And speaking to other people who work in this kind of place, they talk about how important it is to be brought in from the start, but how that doesn't always happen during captive formations. So what are the kind of fundamentals that a potential captive owner needs to know, especially even if they're, you know, involved in investments outside the captive space? It can be a little bit different. Chris?
Yeah, great question, and yeah, completely valid point. Our experience is the same, which is, yeah, it's a critical part of any insurance operation, how you're managing the asset side of your balance sheet, but often it is a bit of an afterthought. Sometimes there's some valid reasons around that. Obviously, you know, you're setting up a captive for specific underwriting purposes. It's quite reasonable that that underwriting sort of business plan takes priority initially. But I think when you look at a captive like I said, there are two sides of the balance sheet to manage, and the liabilities are on one hand with the assets on the other. And in an ideal world, I think both sides, I think everyone would agree that both sides of the balance sheet should be actively contributing to the growth of the captive, and obviously fundamentally supporting the business plan that the captive's pursuing as well, even in the earliest stages of the sort of the captive journey, as it were. I think, Chaz and Oliver certainly both mentioned it. This is a long-term view. You've got to establish a captive with an eye into the future. And I think one of the mistakes that often is made is excluding a proper consideration of the asset management piece. And I think I'd say that in the truest sense of the word. And who is going to be responsible for thinking through the challenges around managing the captive's assets? Not just simply, investing and investment strategies. That's obviously the world that I come from, but I think, not every captive is going to be an active investor, and that's often the right answer. I think for captives with, a small amount of initial capital, or, a limited initial underwriting scope, I think it is easy to sort of defer the question of how we're going to manage those assets, but laying a good foundation at the start is obviously the easiest way to do it in our view. So I think one of the first points to address is governance, and by governance, I guess I mean how is your future captive board likely to be making decisions around how they manage their capital? Obviously, the board is going to be thinking about how to manage the capital in the best interest of the captive itself, and obviously in some domiciles there's also a higher standard to adhere to in terms of how you're managing the capital for the interest of the policyholder, which is another sort of interesting way of looking at it. I think structuring any investment decision, needs to be incorporated from day one. I think perhaps that might take the form of an investment committee or something like that, or even just a standing agenda for the board to consider how the assets are currently being put to work, maybe evaluating current market conditions, or reviewing even what peers are doing, even when you haven't got something active in place. So I think putting some structure in early allows the captive to identify how those decisions are likely to be made in the future. And I guess dovetailing into that point, I would argue that you should really think about incorporating some asset management experience and expertise onto your board from day one. There's plenty of NEDs in almost every domicile who have the knowledge and experience in captive management to sort of lead an investment committee in the future, perhaps. But I think a lot of captive boards have a lot of strength when it comes to risk managers, accountants, underwriting specialists, but sometimes the board perhaps have a little bit of a gap in terms of asset management knowledge. That said, I think once you have got that structure in place and once you've got that governance there, I think that there are probably three main routes that are commonly considered by captives. So the first is that you can obviously continue to hold your capital and reserves in cash. It is worth pointing out we would consider that to be an investment decision, that a captive is taking an active investment decision. I think for insurers, it's important to think about what is my null position, what is my neutral position, and we'd certainly argue that being in a position where you're matching off your liabilities with your assets is probably as close to neutral as you could get. So holding cash where the duration of that asset is zero is great for liquidity, of course, especially if you need all of your capital and the reserves to be called up in a single day, which I think is unlikely for most insurers. It doesn't match off the duration of the liabilities typically. A P&C insurer, you're talking about 1 to 3 year sort of duration liabilities, that kind of range, if you're covering short tail kind of covers. But obviously the longer you go out to life insurance, disability insurance, the duration gets longer and longer, and obviously that's a dynamic that I think most captives should be considering from day one. You don't really want to have a mismatch for the sake of having a mismatch. You want to be cognizantly aware that is a risk if that's something you do want to carry forward. So that's the first option, holding cash. The second option is essentially, I think we see that this quite commonly in Europe, which is delegating in a way the investment management function back to the parent company. Now, I think that obviously applies quite neatly to single parent captives, not so much for group captives or cell captives and things like that. But what we do see is that, we see formally that the cash is perhaps loaned back to the parent, or perhaps informally the captives taking sort of cash management advice from the treasury team or finance team back at the parent company. I think there are a few drawbacks to that approach. Obviously, I think Chaz mentioned minder management. Obviously we've had a bit of a gap in terms of being able to meet over Zoom and things like that, but it does seem likely that we'll get back to the place where actually the regulators are much more comfortable seeing the minder management take place in the domicile where the captive is, not being dictated from by the parent company. And of course, there are going to be scenarios where the parent wants something that the captive doesn't, or perhaps the goals of the parent are not perfectly aligned with the captive. Obviously, the parent may well want to make sure their capital is absolutely there and liquid and cash for them, but perhaps is that really going to work for a captive whose sort of business plan is to ensure the longevity and sustainability of the business by making sure that you're generating an income of some form or other from the capital that you've got on the books. Obviously, the final option is a fairly well-trodden path, one that the world that I'm come from, which is appointing a specialist asset manager to create a portfolio of investments that really suit a captive's profile. Whether that profile is, again, targeting a mandate that's extremely conservative with capital preservation and liquidity at the heart of it, or whether the captive feels like they can take a little more risk and perhaps sort of orientate the portfolio a little bit more towards growth. Either way, I think looking at all these three different options, evaluating them at the start is absolutely good practice, and I think there's a number of questions that you'd have to start answering around any of those strategies. Even if you were to hold it in cash, what's the limits around fixed term deposits? Are we going to put any limits around counterparties that we can sort of interact with? Their credit rating eligibilities, all of those kind of things apply to cash. Obviously, when it comes to an investment portfolio, there's a whole set of guidelines that the captives will need to start putting together, and working with an investment manager who's got a track record of working with captives is obviously a good place to start there. But yeah, creating something that's suited to the captive's risk profile, as Ollie said, I think trying to understand what the risk tolerance is, trying to understand what the underlying insurance business is. I think that the one thing that a lot of sort of bigger firms often miss about captives, and certainly banks, is that this isn't just a pool of money, pool of capital there without being earmarked. It's absolutely set towards having to support the business plan of the captive, and it should be treated as that, as such, with all the compliance needed from a regulatory capital perspective and cash flow perspective and all of that kind of thing. So yeah, so I could go on and on about this, and obviously once you've set it up, there's the whole conversation around how you monitor risk, how you review performance, how you understand what your peers are doing and what the peer group is, what kind of benchmarking to use, all that kind of stuff. But I think fundamentally up front, I think the key questions are how do we need to or want to govern our asset management strategy? What do we really want to achieve from that asset management strategy, and how are we going to implement that going forward? I think those are the sort of the key questions that all captives should be answering probably as early as possible, but it's certainly during the formation stage. And I certainly know that at the feasibility study stage, we've worked with consultants who are able to sort of build in projected investment returns and things like that into the sort of the financial modeling of the captive, which can also be a sort of a useful way to start a discussion around investments at the earliest stage.
Yeah, I imagine, Ollie, you're well experienced in that kind of thing and looking at this from the start, having as a consultant with all of this.
Yeah, I mean, the investment policy and the dividend policy are fundamental, I agree with Chris, to the decision as to whether or not, as one of the decision-making parts of going ahead with the captive. And it is important that people understand that there are investment opportunities. This money is not going to be sitting idle, waiting for a day when a claim is paid. It's money that belongs to the corporation, and the corporation should make it work for themselves in the best possible way. And also, if the investment policy is successful, then there will be occasions when the upside of that investment policy will go a long way to covering the costs of actually running the vehicle in the first place. And that's quite a good conversation to have with the Treasury function when they say, well, hang on, we're paying all this money to have this vehicle offshore. So yes, but it actually could end up as being a net equivalent because of the investment returns. Even if they're fairly paltry investment returns, they should be covering, or one should consider that they might cover some of the initial outlay setting up the vehicle in the first place.
And Chaz, you mentioned obviously earlier on captive examinations, and I think that is something that people think about a lot. If they haven't been through one before, they don't know what to expect, what they need. So I guess, what are regulators looking for when they do their first captive examination and when they're looking at this, Ollie?
Well, I think overall what they're looking for is comfort. They want to know that the owner of the captive really understands why they're setting it up, what the upsides and downsides are, that the organization itself is of good financial repute and will be able to afford not only to run the captive year on year, but also to be able to pay for losses even when they happen. So I think if we break that comfort level down into 6 different areas, the first one is that the regulator will want to understand the structure and the ownership, not only of the parent, but also of the captive. Now, obviously, the way that companies are structured nowadays, there can be quite complex structural arrangements, particularly if there are private equity involved, or if there are other investors, large investments involved. If organizations or individuals have more than a certain percentage, then there's further research that needs to be done on those individuals. But cutting through to understand who ultimately is going to own the parent and how is that structured is one of the first comfort areas. I think the second comfort area is rationale. Why is the organization setting up the captive? Is it because they've just got a short-term knee-jerk reaction to what's going on in the market, in which case, we'd question whether or not that's the right thing to do? Or is it because they see the captive as being a long-term risk management play within their overall corporate exposure? They'll also want to understand why now. Is this something you've just woken up and thought about, or is this something you've been thinking about for some time, but the market conditions now really do make it worthwhile for the short and the long term? So what are the key drivers right now? Regulators also like to know why their domicile has been chosen. There are, as we all know, many domiciles that have captive legislation of various different types, whether it's cell, pure, etc. And the regulator does like to know why have we selected that particular domicile. And sometimes it could be something quite so straightforward as, well, you're only a 1-hour flight away, and that's quite handy when we have to do our visits. Others could be because of the proximity of the reinsurance market, etc. But regulators do like to know why they've been chosen. I think they also want to know what are the future plans for the captive. Now, they don't expect that to be written in stone, of course, at this stage, but if the captive or if the cell is being set up as a monoline carrier in the first year, do the owners have future plans that could expand it into 2 or 3 lines? Do they see it as playing an important part in their acquisition strategy of the parent company? Any sort of general views as to what the organization wants to do with that vehicle longer term is always of interest to the regulators, and it helps to show them that this whole enterprise has been thought about strategically as well as potentially tactically as to what's going on in the market. The third area would be a financial review, the business plan, financial plan. So whilst we talked about the retention analysis earlier on, the regulator will want to understand how those results were determined, and are they really within the financial capabilities of both the captive and the parent in the event that the worst were to happen. And part of that also will be understanding and seeing demonstrable proof that the risk gap between the captive's overall exposure and the captive's overall financial resources will be covered whether that be by a letter of credit, subordinated loan, etc., etc. Well, I want to see tangible evidence of how that is being put in place and that it has been approved and signed off by the board of the owner of the captive. And then the final part of the financial business plan is that they'd want to really be comfortable that solvency margins that are required within that particular domicile are being met / exceeded, to give them that extra financial comfort, because of course no regulator wants to see any financial organization, be it an insurance captive or an ILS structure or just any other financial institution, run into financial difficulty under their watch. So of course they take these things very seriously. I think the fourth part of the comfort gaining is corporate governance, and Chris mentioned corporate governance a few moments ago. Who is going to comprise the board of directors? And whilst the regulator will more than likely know who the local NEDs are and who the local directors are provided by the captive manager, they'll want to know who the other members of the board are from the owner, from the parent company, what their experience and background is. And it never harms to have a face-to-face meeting with the regulator if it's possible, in person or via Zoom or whatever, so that the senior management of that captive can be introduced to the regulator. It's certainly something that we try and encourage wherever we can, provided the regulator is not completely snowed under with new applications, which obviously they currently are. Two other aspects of the corporate governance would be the business continuity plan. What happens if the parent company is bought by somebody else? What happens if the CFO who is on the board of the captive is suddenly incapacitated or resigns? Likewise for the risk manager. And then finally, for that part, compliance and procedures manuals. Can we really demonstrate that all of the underwriting decisions are going to be made in the domicile? And is that encapsulated within a formal procedural document? Because again, people move on, people change. The captives that have been around for 25, 30 years have got entirely different board directors than when they were first incorporated. And it's important to have that rule book, that manual available to all the new members of the captive or employees of the parent company as they get more involved in that captive, because these things have to last. I think then the next thing that the regulators are looking for, the fifth point, would be the dividend policy. And we would always recommend to our captive clients that they don't even consider any form of dividend within the first 3 to 5 years. Keep the cash in the captive, build up the reserves, build up the financial strength, build up the financial underwriting capability of the captive vehicle. And regulators typically do not like to see dividends being passed back to parents in the early years of the captive's life. So they'll be looking for some form of commitment to that. And then finally, I'm very much straying into Chris's area here. They're looking for confirmation as to how the cash and the investments will be handled within the captive. What is their investment policy? And often that is done hand in hand with the manager and with the independent financial advisors that the captive and the parent company use. But they'll want to see how those funds are being invested, not just from the point of view of whether it's in stocks and shares or assets or anything else, but also in what type of investment is being made. We all know that at the moment there's huge pressure on organizations not to be involved in investing in dirty energy. And some of the regulators will be looking very carefully at the investment portfolio that a captive might choose to get involved in, to ensure that everything is up to the level that the regulator would expect for organizations operating in their domicile.
Yeah, that's really interesting. And so, Chris, I mean, just in the investment industry in general, is this a trend you're seeing in terms of people stepping away from certain industries to invest in, like coal or climate change related things?
Yeah, absolutely. I mean, the biggest catch-all buzzword at the moment in the investment industry is ESG, which stands for environmental, social, and governance considerations in your investment portfolio. Certainly, you've seen a lot of pressure from corporates in terms of the way they're investing their treasury function, avoiding, dirty fossil fuels, avoiding carbon emitters, avoiding even, companies who are perceived to be sort of, I guess, sowing divisiveness in society and things like that. I think in terms of captives specifically and looking at captives, there's certainly a pressure in Europe that we're seeing around regulated insurers being asked and expected, I guess, by regulators to have thought about ESG issues and understand how that's implemented. I think that trend is slowly sweeping west, and I think we'll see an inevitability around how those factors are starting to be incorporated into investment portfolios in the US related captives as well. But I think that there's I think the interesting thing about ESG from a captive perspective is there's the other side of the coin, which is, okay, ESG on the asset side of things, yeah, we can handle that. We can put some screens in, we can make sure we're investing in the right kind of companies, that we're not working against sort of the corporate objectives that the parent might have. But there's also, what kind of liabilities are you writing, and is there a risk of compounding some risks around climate change by investing in certain things? So for example, if you're insuring, some flood cover or something in sort of susceptible areas that might be low-lying areas that might be subject to, or that might be especially vulnerable, should I say, to climate change factors, are we making sure that we're avoiding investments in those sort of geographical areas that also might get impacted at the same time? The last thing you want to be doing is liquidating an asset that is somewhat impaired, or the market thinks is impaired, at the same time that you're trying to cover a claim that's covering that exact same issue. So it's almost like, we work with a number of clients who cover catastrophe risk, and we make sure that we're not investing in Caribbean countries or taking on Florida risks during the hurricane season if we're going to need to pay out on a hurricane claim should that ever arise. So I think it's with ESG in particular, it's making sure that those ESG factors that you're working into your portfolio is aligned with what you're doing on the underwriting side, but also aligned with the sort of the corporate values that the parent captive or indeed the owners might have.
I think that's a good point you make there, Chris, about the alignment of those interests, because clearly we're seeing at the moment in the traditional insurance and also in the reinsurance market, capacity being withdrawn wholesale in coal mining and other fossil fuel and oil activities. But of course, I think that there's one particular head of an insurance company who voiced my concerns, although obviously he didn't think they were mine at the time when he voiced them, which is basically, if we suddenly pull out of providing cover for all of the existing mining, oil and gas infrastructure around the world wholesale, then there will be operations, particularly in developing countries, that simply can't get cover and simply have to shut down operations, laying off tens of thousands of people who are already on the breadline. Now, if a captive were to be established by one of those organizations to try and provide the cover that it can't get from the traditional insurance market, then the regulator in that chosen domicile should support that captive, because that captive is enabling that business to continue and enabling people who work in that facility to continue to have an income and to have a life that is sustainable. And this is one of the very difficult alignment of interest conversations that would need to be had with the various regulators in the various domiciles if we were to be looking at that type of activity.
Oh, Chaz, are you on mute?
And Ali had earlier said, the regulators may be interested in why are you in my domicile? And this might be another question. What coverages are permitted in that domicile? We see in the US, for instance, punitive damages. There are a handful of states that permit punitive damages to be insured, whereas non-US, there may be others. and what Ollie and Chris just talked about in terms of insuring the coal mines, oil, etc. Maybe there are domiciles which will do it and other domiciles which will not.
No, I think this in particular is a really interesting issue because it's obviously rightly so becoming a lot more important. But as you said, Ollie, if it was as easy as, you know, flicking a switch and then you're not invested, you know, all businesses would do that. But it's a lot more complicated than that the majority of the time, especially if you have a big business and a big company. So we've got a few questions here. I just want to remind everyone that you can go to Slido and put in some questions. Before I get to those, is there anything that any of you want to mention before we head off to the questions? All good? Fantastic. All right, so we've got Shana who's going to bring up our questions now, which is really great. So we'll put this one first. We've got Glenn Ellis who has said, in terms of compliance, e.g. local tax, comprehending and premium retentions, any real life examples of these costs being factored into a captive's budget? Chaz, what's your experience with that?
Well, certainly the local tax in the US, there is people used to sort of either defer, minimize, or just completely ignore the state tax, particularly the self-procurement tax in the US. And over the last decade or so, that has become a much more real factor that people are not only, you know, cognizant of, but they are putting that a number in their feasibility studies. So this will be the local tax component. With respect to the reinsurance ceding and premium retentions, I think at least in my experience, there are more people going to their commercial brokers and saying, all right, if I raise my retention, how much reduction do I get from my commercial premiums? And in a hard market as we are entering or have entered, that is a real factor in determining how much is the captive going to insure and how much am I going to try to put in the commercial market.
Well, yeah, I know that the self-procurement tax and the state taxes are obviously a very big issue, and especially at the moment, given the new Washington state bill passing, and there's a lot of focus on that. So I guess it is something to consider and to make sure is on your mind if you are forming a captive.
Right, and a lot of people also, in terms of something tangible, in new formations, that is a very important factor that people are taking into account as to where to domicile. Do I domicile in my home state? And you see it sometimes in redomestication questions, but you really see it very definitively in new domicile decisions.
All right, I'm going to try and get through these as quickly as we possibly can because we have quite a few questions, which is great, but I want to make sure that we get to as many as possible. So I know this is a difficult one to answer because it obviously depends on the company, but what is the best captive, including reinsurance, retrosession structure, in your view, to deal with low frequency, high severity exposures? Ollie, what's your view on this?
Wow. Yes, that's a wonderfully broad question and very important question. And without wanting to duck the answer, I'll start off by saying it depends. You know, are we talking casualty? Are we talking property? Are we talking motor? Are we talking life? Are we talking disability, accident and health, travel, and so on? That's the first thing. Low frequency, high severity. You know, I think if one were to take a first loss retention and then to try and buy a second and third loss stop loss cover, then you know, the company will be able to absorb the first hit, whatever that might be. You know, high severity, 5 million is unbearable for some companies, and 100,000 for other companies. So whatever that appropriate level might be, take that as being the first hit, and then buy reinstatements or second and subsequent loss cover. That would be one way of looking at it for sure.
Right, thank you so much. And so both Chris and Ollie, you both mentioned, kind of disagreement or non-alignment of interests between a captive and a parent, and making sure that's all aligned. So what do you see as the main areas where you see it? Chris, I know you mentioned ESG. Is there anything else in the investment space?
I guess from my perspective, obviously my view is somewhat limited in terms of the actual sort of interaction I see between a parent and a captive. But typically, what we do see is, in terms of ESG, that's definitely one issue that is worth considering. The other area I think is around risk appetite. Essentially, boils down to risk appetite. You typically see the parent thinking, okay, well, the amount of capital that I have in this captive is a relatively small portion of my assets as a business. I'm going to keep that in cash because I know that it'll be there to pay claims. Whereas the captive board may well be thinking, well, actually, I'm going to need to earn a return a return from this capital. As Oliver said, perhaps I want this capital to sort of wash the face of the captive, make sure that it's paying for the annual costs, et cetera, et cetera. So I want to take some investment risk and I want to earn some investment return. And I think that's the biggest sort of area of friction and perhaps non-alignment. And I think, to be honest, it usually comes down to individual viewpoints from individual people, i.e. the person in your treasury team may well be thinking differently from the chairman of your board. And it's, invariably it's something that can be worked through and compromised on. But that's probably the biggest area that I see.
Ollie, anything you want to add to that?
Yes, I think also on the coverage side, the captive might want to try and ensure that its policy wordings are follow form with the excess market, so that there is no questioning about whether or not a retention applies or an aggregate retention can be eroded by non-covered losses, for example, versus the corporate who might think, well, we have our own insurance company, let's write a policy that's as broad as we want. Without necessarily understanding the interplay between the captive retention and the excess or reinsurance markets.
Yeah, I mean, as lovely as it sounds to write an insurance policy that covers everything, and you have almost no premiums, that just isn't how it works, even when you own it yourself. So, all right, so I know that, again, this is a very broad question, but generally what are captive setup and formation costs? Ollie or Chaz, do you want to go for that?
Sure.
Ollie?
So, I mean, again, the classic, it depends, because it's going to depend on which location, it's going to depend on which manager, it's going to depend on the number of lines of business, etc., etc. What I can say, though, is that you can go as low as perhaps 11,500 US for the formation, all the way through to 70,000 US. And then for the first year management, anything from 16,500 US up to 250,000 US. So a total of somewhere between 28 grand year one to 300,000 year one. And that's a very broad range, but it has to be, because there are so many moving parts within that. And indeed, there are some locations that are much more expensive than others, and that's simply because of where they are in the world, the level of people there. If you're in a very developed major cosmopolitan city, you have to pay staff more, your premises cost more, and so therefore the overall cost of managing that vehicle will be higher than if you're in another location.
Yeah, a couple of things I would add is that there's a big difference between whether it's a single parent captive or whether it's a group captive. And I had one other item and I'd forgotten what that other difference was, so I will move on to the next one.
That's right. So we'll go with now. There's a question here. Is there a single source?
Oh, I'm sorry. Yeah, it was the extent to which the captive manager is going to be dealing with the claims and the number of claims that are going to be running through the captive. That was the other point I wanted to make.
No, exactly. So yeah, is there a single source which maintains self-procurement tax information, Chaz?
I am not aware of a single source that's exclusively what it does. I have seen it in a very big multi-volume insurance regulatory treatise, but that's, one piece of one volume out of 7 volumes. And I suspect if you had a 7-volume tax series, you'd have a small one on self-procurement, but I'm not familiar with like a little pamphlet that's exclusively what it looks at.
Yeah, I'm not aware of anything which, I mean, I wish there was a single source. It would make my job easier sometimes, but I'm not sure, I don't know of it. All right, so we've got how solid does the reinsurance department have to be in the parent to control a decaptive offshore? Ollie?
I think it's always useful for the parent to have somebody who is going to be responsible for the offshore vehicle to be knowledgeable in the basics of insurance. And even if that's not their full-time job, he or she should have an understanding of what it all means. They don't have to have a technical understanding of how the dark arts of the reinsurance market work, because that's why they would have their broker. And we always advocate that it is important for a captive to have a broker, be it at the front end putting the business into the captive, or at the back end taking the business into the reinsurance market. But they do need to have somebody who understands the high level basics of insurance and what reinsurance would mean to the captive vehicle.
All right, we've got one last question from Susan, and I think we can all kind of speak about this in terms of, with the pandemic's impact reinsurance, curious if you've seen an uptick in particular industries more interested to start a captive. And so from my perspective, we speak to a lot of different people, a lot of different regulators. I haven't heard of particular industries. I've heard of interest in big spikes in interest in certain lines of business, many of those which cover quite a wide range. But yeah, I mean, Chaz, in your business, are you seeing, what areas are you seeing captive interest in at the moment?
Well, to this point, I think hospitality and events, those would be 2 industries that I see an uptick in as a result of the pandemic. More globally, I see the hard market is also another driver towards increased activity or interest in the captives.
Chris, in your area, what kind of areas are you seeing, if there is a specific one?
Yeah, it's a tricky to pinpoint it exactly, but I think, as Chaz said, I think the bigger driver for the activity that we've seen has actually been the hard market, which is kind of somewhat related to obviously to the pandemic and what we've seen in terms of the economic impact on from COVID. I certainly know from working in financial services that D&O cover in particular, and sort of as well as general sort of liability cover has been professional liability cover has been difficult to get hold of, and when it has, terms have been coverages have been cut, and also the premiums have been hiked. So I'm no doubt financial services have been hit, but I'm sure it's a bit more broad than that as well, and I'm sure Ollie is probably best placed to see exactly what's going on in the ground.
Yeah, Ollie?
Well, I'd certainly agree with what both Chaz and Chris said there, from the point of view of the hospitality and also the point of view of the financial service, financial lines. The other area that we've seen a very marked increase in the interest in setting up captives has been in the travel sector. And whether that's the UK travel sector, where the market basically disappeared last summer for tour operators, travel agents, airlines, packaged trips, as well as the individual personal lines travel space, but also for governments who are thinking of how they can actually start building a new revenue stream once travelers start traveling again. by setting up visa schemes whereby you buy a visa to enter the country, it gives you some healthcare cover whilst you're in country, and all of that goes into a captive vehicle. And these are all ways that people are looking to use captives, either to bring new capacity to a very distressed market space, or to build up additional revenue to try and recoup the losses of the previous 18 months.
Yeah, I think that's really interesting. And I mean, as you mentioned, Chris, D&O has obviously been a very hot topic at the moment with huge increases to premium in the commercial sector. We actually, Captive Review is doing an event, a webinar on the 2nd of June on not only D&O and captives, but D&I and the crossover between D&I, ESG, and coverage like D&O. So if you're interested in that, any of you listening, please attend. We have gone slightly over, but I think we had a fantastic discussion today. So thank you, all of you, so much. We really appreciate your time. And yeah, just quickly before I go, I'll just say to anyone listening, obviously, you can go back and listen to the formation webinars on the website. The previous ones, they're all live. You'll be able to rewatch this. We have a couple of more events coming up this month. So we have our Power 50 social, which is on the 20th of May. So please get in touch if you're interested in that. And we have a webinar with Bermuda, focused on the Bermuda area at the end of the month as well. And you can find all that information on Captive Review. But yeah, that's it. Thank you all so much. And I hope you have a good rest of your day.
Thank you.
Thanks.